So at the beginning, I have to go over some of the notation, some of the terminology that we're gonna use throughout this chapter. So first, a capital C refers to the American call option price, while a lowercase c refers to the European call option price. The same applies for a put option. We're using uppercase and lowercase p. For the strike price, we'll be using either X or K. And as I said before, like some books, they use X for the strike price, while others use K. Capital T will refer to the expiration date of the option. So this is the time when the option must be either exercised or it should be, it will expire out of the money. Lowercase t refers to any time between the issue date, time t equals 0, and the maturity or expiry date, capital T. So this is the issue date at time t equals 0. And at time capital T, this is the expiry date. Whenever you see lowercase t, so for example, if you see CT, this is the American option price at any time between time t equals 0 and the expiry date. If we want to talk about C capital T, this refers to the price of the American call option exactly at expiry date, while C0, this is the American call option price at time t equals 0, like when the option is first issued. S will refer to the price of the stock, and of course here we'll also use subscripts 0 like lowercase t or capital T. D will refer to the present value of dividends during the option's life. So if this option, let's say, is over a 1-year period, so T equals 1 year, and dividends are paid quarterly. So mainly we have 1, 2, 3, and 4 dividends. So here you will have D1, D2, D3, and D4. So the present value of all of those dividends is capital D. And as we're gonna see, like for non-paying dividend stocks, it's gonna be D equals to 0. R refers to the risk-free rate for maturity T with continuous compounding. And finally, sigma will refer to the volatility or the standard deviation of the stock price. Now, the assumptions that we have in order to assess the properties of options, of stock options, we have certain assumptions. I'm gonna go over the most important of those assumptions. The first assumption is the perfect market condition. So under this assumption, there are no transaction costs, there is no bid and ask spread, we do not have any margin requirements, there are no restrictions on short selling, there are no taxes, and most importantly, borrowing and lending is available at the risk-free rate. So whether you want to borrow money or lend money, it's gonna be at the risk-free rate. The second assumption is that there's no counterparty risk. So in this case, market participants will not entail any counterparty risk. So there won't be any default by the party with the short position on an option. The third assumption is that markets are competitive. And in this case, market participants, they act as price takers. This means that their volume of trading will not affect prices. So for example, if you have an investor or a trader placing a large order to buy call option, that order will not lead to an increase in the price of call options. So in this case, options prices are not affected by supply and demand forces. If there's a higher demand to take long or short positions in options, this won't lead to any change in the price. So traders, they will act as price takers. Whenever they buy or sell, they will transact based on the prices available in the market. Now, assumptions 1 through 3, they describe an ideal financial marketplace. Mainly, those assumptions are not realistic. And just to give a quick example, like it can never be the case that we as traders, we can borrow and lend money at the same rate, at the risk-free rate. However, those are used as a first approximation to reality. And this applies to most theory models in finance. So mainly we have a set of assumptions to simplify things. And once we make our points with respect to this perfect world or to this ideal financial market, we can then check what will happen whenever we relax one of those assumptions or more than one assumption at the same time. So as I said, this is just to simplify things, and even while trying to simplify things, we will see that some of the properties are still gonna be slightly complicated. Now, the last assumption, which is one of the most important assumptions that we're gonna see, it relates to the no arbitrage assumption. Now, to define like arbitrage, this is a risk-free opportunity to generate a return. And in theory, such opportunity won't require any initial investment. So just to give a quick example about an arbitrage opportunity, first I'll give an example that's not related to options. So in this example, let's say that we have a certain stock A, I will call it, which is listed on 2 exchanges. So this is exchange 1, this is exchange 2. And both exchanges, they have the same currency. So we're not talking about different currencies. Let's say that in exchange 1, the price of A is equal to 72.51. In the second exchange, it's 72.63. In this case, there's a clear arbitrage opportunity because those are the shares of the same companies. So they should be equal. However, because they are not equal, there's an arbitrage opportunity. And the rule is that whenever you have, let's say, C and D, where they should be equal, you see that instead C is greater, let's say, than D. And they should be equal. In this case, in order to benefit from this arbitrage opportunity, because you know that in the future, the prices will converge. Like in the future, C is gonna be equal to D. In this case, what you can do, like simultaneously, you can take a short position in the one with the highest price, in this case, this one, because 72.63 is greater than 72.51. So first, we take a short position. We will receive plus $72.63 in cash. We will use this cash to take a long position in D. In this case, we will buy the shares listed on exchange 1. In this case, we need to pay 72.51. So as you can see, at time t equals 0, we will have a cash inflow of $0.12 per share. So now, at time t equals 0, we have plus 0.12. In the future, because remember, we have a long and a short position. Now, what type of cash flows we may see in the future before we have this full convergence? For the exchange one, the share where we have a long position, we will be receiving dividends throughout the way. And at the same time, we will need to pay a dividend of that same value due to the short position that we have. So all the futures cash flow, so this is D1 minus D1, 0, and later on plus D2 minus D2, 0. So in the future, we won't have any cash flows. And once the prices converge, we will close simultaneously our positions. So in this case, we will end up with this risk-free profit of 12 cents per share. And as you did see, like theoretically speaking, it's like this arbitrage opportunity doesn't require any initial investment, because I do not even need to have any money in order to capture that profit of 12 cents, because I'm using the proceeds of taking the short position in order to finance the long position. Now, this is based on the assumption that we have that there's no margin requirement, because as you all know, when you take a short position, there are margin requirements. So now, financial markets do not permit arbitrage. Why is that? Because simply, if there's a risk-free profit that's available to all investors will want to benefit from such arbitrage opportunities. So if I go back to that example, if that's the case, all of the investors will be taking long position here and a short position here. So buying the shares on exchange 1 and shorting the shares on exchange 2 will push the price per share on exchange 1 up, and those short positions, they will push the price down on the second exchange. So what will happen later on, the two prices are gonna be equal, so the arbitrage opportunity is eliminated. So whenever investors, because at the end of the day, investors, they are competing in the financial markets, they are trying to maximize their profits. So if they see that there's an easy profit, a risk-free profit, each investor will want to participate and have his or her own share in that easy profit. So simply put, this means that there's no free lunch in the financial markets. And based on the no arbitrage assumption, all assets with identical payoffs must have the same price. And this is known as the law of one price. So for example, if I have those two assets, with the following cash flows, C1, C2, and C3, let's say. This is asset number 1. Asset number 2 has exactly the same cash flows, C1, C2, and C3. In this case, those two assets, they should have the same price. So A1 should be equal to A2. If that's not the case, this means that there's an arbitrage opportunity. If A1 is greater than A2, an investor can take a short position on A1 and the long position on the second asset, A2, because the future cash flows, they will cancel out. So the risk-free profit in this case is the difference between A1 and minus A2. This is gonna be the profit from the arbitrage opportunity. So in order to eliminate arbitrage, if we are assuming that there's no arbitrage, A1 should always be equal to A2. So any assets with the same stream of future cash flows, they should always have the same price. And we're gonna see that this assumption is a very powerful assumption because it will allow us to value and to price and to find the relationship between options, especially when we start talking about combining different options, creating a certain strategy. This will allow us to determine the payoff and the profit of such strategies. Now, there is no asset that has a positive payoff later and a non-negative payoff now. If such an asset exists, we will all want to invest in such an asset. This means that, let's say that here at time, whether capital T or at any point in time between time T equals 0 and capital T, we are gonna receive a positive cash flow. If this is the case, we should be paying something to buy that asset. If that asset is available for free, or like we will be receiving a small positive amount at time T equals 0, and then in the future we'll be receiving another cash flow, all investors will wish that such an asset exists. All investors will go and buy that asset because at the end of the day, there's no cash outflow. It's like they are not paying anything to acquire that asset, and still they're gonna receive a positive cash flow in the future. Now, with the examples that we're gonna go over, and like mainly most of them are not numerical examples, we will see, you will have a better idea about the application of the no arbitrage assumption. So now the logic for ruling out arbitrage in financial markets is quite simple. There are millions of self-interested investors in the market waiting to make a quick buck, ready to gobble up any available free lunch. So mainly, when arbitrage opportunities prevail in the market, they will last sometimes for seconds, for very few minutes. And actually, like large institutional investors and algorithmic traders, they have algorithms, they have programs that scan the market, whether we are talking about derivatives markets or other markets, in order to identify any arbitrage opportunity. And once the program identifies that there's an arbitrage opportunity, the program will trigger buy and sell orders in order to benefit from such opportunity. So mainly they won't need any human intervention because there's no time. If you see the opportunity and you're late in taking the decision to benefit from this opportunity, this means other investors, they already did their job, and they did buy and sell based on that arbitrage opportunity in a way that they will eliminate completely that arbitrage opportunity. Because remember, whenever the arbitrage opportunity is still there, you will keep on replicating whatever you're doing. You will keep on short selling and taking long positions until this arbitrage opportunity is fully eliminated. Okay, now starting with the properties, with some of the properties of options. First of all, the relationship between the American option versus the European option. So mainly, with an American option, you can exercise at any point in time between time T equals 0 and the expiry date of the option. However, with the European option, you have the right only to exercise at the expiry date. You do not have the right to exercise before the expiry date. So as you can see, the American option will definitely have a greater value, or a greater, its premium is gonna be higher relative to a similar European option. Because simply with an American option, you can do whatever can be done with the European option in addition to the early exercise option. So in this case, we can say that the value of the American option is the same as the value of the European option, because with both of them, you can exercise here at expiry. So this is a common feature between the two. So that's why an American option is always either equal to the European option plus the early exercise option, because here you can exercise early. This will make the American option most of the time with a greater value relative to the European option. So we can say that whether we are talking about call options or put options, the American call is always greater than or equal relative to the European call. The same will apply for put options. Now, the longer the time till expiry, the greater the early exercise option and the greater the difference. As we approach, so as time passes and we are approaching the expiry date, so exactly when we reach the expiry date, in this case, C is going to be equal to lowercase c, and the same will apply for the put option. Because at this point in time, the early exercise option is going to converge to 0 once we reach the maturity date or the expiry date, capital T. Now, regarding the maturity and the options value, let's go over this example. So let's say in this case, we have two options. I will call those options, call options C1 and C2. C1 has an expiry date at T1. C2 has an expiry date at T2. So when I'm comparing C1 and C2, I can see that whatever can be done with C1, it can be done with C2. So it's like C2 is equivalent to C1 plus the option or the right to exercise between T1 and T2. So mainly I can say that C2 will have a greater value relative to C1. So C2 is always greater than or equal to C1, because simply you have the option to exercise between T1 and T2. Now, the bigger the difference between T2 and T1, the bigger the difference between C2 and C1. So in this case, for T2 greater than T1, C2 is going to be greater than C1 and P2 is going to be greater than P1. Now, regarding the relationship with the strike prices, let's also have an example. And here I will have separate examples for call and put options. So first for call options, let's say that we have X1, for example, is $50. X2 is 55. In this case, C1 gives you the right to buy at $50, while C2 gives you the right to buy at 55. And remember, when you exercise the call option, your payoff is gonna be S minus X. And in this case, S minus 50 is gonna be greater than S minus 55. Or I can say that S minus X1 is greater than S minus X2, given that X2 is greater than X1. So simply here I'm saying the payoff of C1 is greater than the payoff of C2, given, of course, that the options can be exercised, given that the stock price is greater than the strike prices. And as you can see, there, for any price between $50 and $55, I can exercise C1. However, I cannot exercise C2. So mainly C1 will always have a higher value relative to C2. So the call option with the lower strike price I will have a higher call option value. So this is mainly what will happen with call options, because I'm paying X, I'm buying at X, the call option gives me the right to buy at X. The lower the price at which I'm able to buy, the higher my call option value. Now for the put option, it's gonna be completely the opposite. So here another example with a put option. I will use the same strike prices. So I will have X1 equals 50 and X2 equals 55. This is P1, this is P2. And in this case, the put option will give me the right to sell. So when I sell, I will be receiving the strike price. I will be receiving X. It's going to be X minus S. So in this case, the higher the strike price, the higher the strike price X, the higher the value of the put option. Because when the option can be exercised, when the stock price is below the strike price, for P1, I will be receiving 50 minus S. While for P2, I will be receiving 55 minus S. Definitely 55 minus S is greater than 50 minus S. So this will imply that P2 is greater than P1. So here the relationship is the opposite of that of a call option. So when the strike price X increases, the put option will increase in value while the call option will decrease in value. For the stock price S, the higher the stock price, the lower the value of the put option and the higher the value of the call option. And here we have a summary of the properties. So here I have first the European options, and then I have the American options. So the higher the price, the stock price, the higher the value of the call and the lower the value of the put. For the strike price, it's the opposite. So there's a negative relationship between the strike price and the call option premium, while there's a positive relationship between the strike price and the put option premium. Now for the volatility sigma, the higher the volatility of the price, the higher the value of the option, because this means that the price can attain extremely high values or low values, which is good whether an investor has a call or a put option. Now, regarding the time till expiry, mainly the time till expiry has a positive relationship, as we did see. So mainly with American options, there's always this positive relationship. However, with European options, it's like we have a special case. So with the call option, it's a positive relationship. However, with the put option, With a European put option, most of the time it's a positive relationship. However, the inverse effect can prevail under special conditions, and we will see those special conditions once we discuss the early exercise conditions for options. So mainly this negative relationship will be when the put has a longer time to expiry. So when ST increases and the risk-free rate is high, the higher the risk-free rate, and the deeper the option is in the money. Why is that the case? Like, just let me quickly explain why this relationship can be negative for the European option. So let's say that this option has an expiry date of 5 years, for example. The risk-free rate, let's say, is 10%. And let's say that the option is deep in the money. Let's say that X equals 50. Currently, the stock price is $5. So for this option, if you are able, let's say that we are here now, this is time t equals 0. This is time t, maybe this is at year 1. So we still have 4 years till the expiry of the option. So here I did take an extreme example just to show you why with the European option we may have this negative effect. So now if you are able to exercise here, if I exercise at t equals 1, I will be receiving 50 minus 5, I will be receiving $45. Now this $45 can be invested over a 4 years period at 10% rate, at 10% annual rate. So as you can see, if I'm able to get that payoff now, this can grow. So I will have like 45 times E to the power R, which is 0.1 times 4. So it will be 45 times E to the power 0.4. So in this case, by not having that option to exercise early, I'm foregoing that value. I need to wait till I get here. So I'm losing, the proceeds from such an investment, from investing the payoff of the option. That's why under those specific conditions, the value of the European put option is maybe inversely related to the time till expiry. This can never happen with an American option, because with an American option, I can exercise here. So mainly the value of the option is gonna be greater. And this is something, as I said, we will discuss in more details once we get to the early exercise conditions for American options. Now, other factors, you have the effect of the risk-free rate R. So the higher the risk-free rate R, the higher the value of the call option and the lower the value of the put option. And here, if you want to think about the relationship between the risk-free rate and, let's say, the call premium, remember that with the call premium, you are paying X. You're going to buy. So in this case, let's say that you have $1,000 set aside in order to buy the shares once you decide to exercise the option. So usually you will leave this $1,000 invested at the risk-free rate. So if the risk-free rate is high, this means you are making 10% on that $1,000. In this case, the earlier you exercise, you will end up paying that $1,000. While with the put option, it's the opposite. With the put option, because you will end up receiving X, you will end up receiving the strike price. Now for finally for the dividend D mainly will reduce the stock price. So whenever you have a dividend that's paid, let's say at time t equals 1, we have a dividend D1, the price will decrease, so S will decrease to S minus D1. This means that this is good news for the put option holder, while this is a bad news for the call option holder. So there's a negative relationship between the dividend paid and the call option price, and the positive relationship between the dividend paid and the put option price. Okay, now in this part, we will try to identify the lower and the upper boundaries of the option price. Later on, once we cover the binomial model and the Black-Scholes-Merton model, we will try to value or price options. In this chapter so far, we'll just try to identify a lower boundary and an upper boundary of the option value. So we start first with the lower boundary. Now, due to the limited liability of an option, because remember, the option gives you the right and not the obligation to exercise. In this case, you will only exercise if the option is in the money. So if the option is in the money, you will exercise. Otherwise, you will choose not to exercise. So for that reason, the value of an option can never be negative, because there won't be any cash outflow in the future. So mainly, you pay here at time t equals 0. You pay the price. Let's say you are buying the call option. So let's say it's $7. So here you pay $7. In the future, if you decide to exercise, you will be receiving, as an investor with a long position, you will be receiving the cash flow from exercising the option. The only cash outflow that you may witness is at time t equals 0, when you pay the $7 to the party with the short position. So as the holder of an option can always choose not to exercise, the option cannot impose any liability on its holder. So at any point in time, the payoff of the option is 0 at worst and possibly positive. So the worst case scenario for a party with a long position is that the option expires out of the money. The option is not exercised. In this case, the option holder will receive 0. However, if the option is in the money, there may be a positive payoff. For that reason, options values are always greater than or equal to 0. Now, in order to determine more, like now we've said that it should be greater than or equal to 0. Now we will try to determine a higher, if you want, lower boundary. So we started with 0. We've said that call and put options, they should be greater than or equal to 0. Now we will determine a higher lower boundary for American options. Now, for American options, CT is greater than or equal to ST minus X. ST minus X is the payoff or the intrinsic value of the call option. So this is what you will get once you exercise. For the put option, it's the same. The American put option premium should be greater than or equal to the payoff of that put option, greater than or equal to X minus ST. So let's say that I'm considering a call option. This is time t equals 0. This is capital T. Currently, we are here. This is lowercase t. So we still have some time before the expiry date. So now if I decide, if the option is in the money and I decide to exercise, I will be receiving, in this case, because this is a call option, I will be receiving ST minus X. This is the payoff from exercising the option. Now, the option can be exercised because it's an American. It can be exercised at any point in time given that the price of the stock is greater than the strike price. So let's say that an investor holds that option. This investor can exercise and grab ST minus X. However, in this case, if the investor exercises early, that investor will lose this value here, which is the option or the right to exercise between t and lowercase t and capital T. And because of the limited liability of options, that option to exercise here is always greater than or equal to 0. So if you exercise early, you will get ST minus X, and you will lose the value to exercise between time lowercase t and the expiry date capital T. So now let's check those two cases. In case 1, the call premium is equal to $5. The stock price ST is equal to 60. X is equal to 50. So here mainly we are saying that C should be greater than ST minus X, greater than or equal. In this case, C is equal to 5. ST minus X is equal to 10. So in this case, there's a clear arbitrage opportunity, because if such prices prevail in the market, you can make an easy money. You can buy the call and quickly, at the same instant, you can exercise it. Buy the call and directly exercise it. In this case, you will pay $5 to buy the call, so you will have minus 5. You will be receiving, when you exercise, you will receive ST minus X, 60 minus 50. This means you will end up with plus 5. And you can keep on doing that. You buy the call, you quickly exercise, you grab $5. Then you buy another call, you directly exercise it, then it's an additional $5, and you can keep on doing that as long as CT is not greater than or equal to ST minus X. Now, in the case of a put option, let's say that P is equal to 5, S is 32, and X is $40. So in this case, if I buy the put, I will pay $5. I directly exercise, I will have 40 minus 32. I will have plus 8. So I will be making an easy profit of $3. And I can keep on replicating that strategy. Now, the difference between the example here, like my explanation here, and those examples is that in those examples, I'm saying that most of the time for American options, the call should be greater than or equal to 10. So C should be greater than or equal to 10. So here I'm saying why it may be the case that the call premium must be greater than 10 and not only equal to 10, because of the option to exercise between this lowercase t and capital T. However, once I get here, once we reach the expiry date, CT is gonna be exactly equal to ST minus X. Okay, so here we have the general case, how we can prove that the American call option in general should be greater than or equal to ST minus X. So this is the general case, and in the first project, you will be required to write similar proofs for different situations. So here we are assuming that, let's say, if CT is less than ST minus X, we'll see what will happen. So if we violate any of the assumptions, this means that it can never be the case that CT is less than ST minus X. Now, the first case, let's assume that, because here, when you have the strike price X, you will consider two cases. If S is less than X, if S is greater than X, if the option is in the money or out of the money. So case one, if S is less than X, if S is less than X, this means that S minus X is negative. So if S minus X is negative and C is less than S minus X, this will imply that C is less than 0. However, this will violate the limited liability of an option because the option at worst is equal to 0. So in this case, this can never be the case that C is less than 0 because C is always greater than or equal to 0 due to limited liability. Now, the second case, if the call option is in the money and S is greater than X. In this case, the intrinsic value of the call is S minus X greater than 0. So if we had a call, we would exercise it with a profit of S minus X. So as the profit of exercising the call is greater than its cost, we can implement the following arbitrage strategy. Buy the call for C and exercise it immediately for a net profit of S minus X minus C greater than 0. Because remember, here we are assuming that C is less than S minus X. So when I exercise, I'm receiving S minus X. However, because S minus X is greater than C, I will have S minus X minus C is greater than 0. So now, by combining the two properties together, when I talked about the limited boundaries of the American options, we can combine them to get to the following. The call option value, the American call option value, is always greater than or equal to the maximum of ST minus X. This is when the option is in the money. And 0, this is when the option is at or out of the money. For the put option, it's similar. The put option, the American put option value is always greater than or equal to the maximum of X minus ST when the put is in the money and 0 when the put is out of the money.